Hey, everybody, last time you saw me, I was explaining a 2-1 buy down and the advantages of being able to sell properties quicker if you're an agent or really help those buyers recapture the lower interest rates that were available at the beginning of the year so that they could feel more comfortable buying now while there's actually inventory. So, today and on that last video, I promised that I was going to show you the next one would be what about doing a permanent buy down versus a 2-1 buy down. Well, I'm an overachiever. That's who I am. So I'm actually comparing no buy down to a 2-1 buy down to a permanent buy down to a price reduction. So let's get into it. So first off, let me switch over here. I am showing you a $750,000 purchase price, $150,000 down, which is 20% down. So we got a $600,000 loan amount. We're going to go in and say, what's the different comparisons look like? So let's say I'm just a normal dude. I'm doing a no-point loan. I go ahead and I get my 7.25 rate based on my FICO scores and the down payment and all that stuff. My payment without taxes and insurance is $4,093. With taxes and insurance, again here in California, 1.25% regular tax rate, and homeowners insurance about $4,974. Now let's say instead I'm going to negotiate a lower price of $14,143. Now, the $14,143 is a really weird number. It's a really weird number because it just so happens to be what it cost for a 2-1 buy down, and so I want to stay consistent. Remember, the seller doesn't care. If they're going to give you money, either a price reduction or money towards a buy down or closing costs, they don't kind of care what you use it for because their net basically is going to be the same no matter what you use it for. So let's go and say we're going to price reduce. We're going to hammer them down on price. We're going to save $14,143. What does that do for you? Well, what it does is it brings that payment from $4,093 on the principal interest to $4,016, or with total cost with taxes insurance $4,897. Woohoo! Super exciting, $80. I'm not that excited about it. Are you? I'm just not that excited about it. So now let's say I'm going to take that same $14,143 and instead I'm going to apply it to discount points to buy down my rate permanently. Because of the way the markets are right now, and the markets expect these loans to be refinanced very shortly, within like 1 to 2 to 3 years, they're really not giving the same value on loans. And so what happens is that if the buyer like you pays a little bit more money to get that rate bought down, it comes down a lot. So for example, on this one here, I'm going to still go back up to my regular $600,000 because now I'm not asking to reduce price. I'm asking him to take $14,143 and apply it to buying my interest rate down for the life of the loan, 30-year fixed. Now I get down to 6.25 from 7.25. Now that's a way big jump down, right? So that means now I'm going to be paying about $3,694 in principal interest and $4,576 for the life of my loan versus even if I negotiate a better price, $4,897, or if I didn't get the seller to pay anything, $4,974. Big difference, right? We're seeing that value of that money in the long term, even on a permanent buy down, become very powerful. Now, last deal, we're going to look at a 2-1 buy down. That's what we went over last time. And on this one, for example, here we get down all the way down to $3,313 if we use that $14,143 up front to buy down the interest rate by 2% the first year, 1% the second year. Now my payment's only $3,313 for principal interest or $4,194, which seems super great, right? But remember, that's only for the first 12 months. Then it's going to go up to 6.25%, which again, we can see the payment right here because it's right next door at $4,576. And then after that, it's going to go up to this 7.25 payment, remember, because it's going to be $4,974 for the remaining period. So what's the moral of the story here? What's right for you? Well, if we do the 2-1 buy down and we really think, and if this chart kind of shows this, by the way, I'm not going to go into a really long explanation here, but this chart goes to show you that if you think you have the ability to refinance within the next 1 to 2 years, which I think there's a great possibility after the Fed hammers these short-term rates that they're going to bring inflation out and interest rates are going to come down and that you're going to have the ability to refinance, then you use the 2-1 buy down. And if you do it in a year, there's money left in that buy down account that the seller funded that could actually be used to pay for your refinance because that money just sits there and supplements the interest you would have been paying at the note rate for that first 2 years. So you have that money there set aside. If you refinance with the next year and a half, there's to be some money that would actually come back to you that you could use for that refinance. But now let's say, hey, I really don't know if I feel comfortable about this happening and that I'm going to be able to refinance. And I'm more of a conservative. I want to be careful. Well, then do the permanent buy down because that's for the life of the loan. Yeah, the savings isn't as much. And again, look at this. The saving isn't as much as the 2-1 buy down for the first year or two, but or like really the first year, but it gives you a permanent buy down for the length of the loan. And you could still refinance if rates go down, which again, been doing this for a long time. They're very likely to go down and give you the opportunity to refinance. But the permanent buy down, again, kind of no risk as compared to the temporary buy down where you could go up to that higher rate. But let's say you're going into that buy down, maybe that's what you want to do and you just really want to get that lower payment up front, then that's why you would do a temporary buy down. Permanent buy down, safe, secure, and long term. Temporary buy down, biggest bang for your buck, get the lowest payment up front and grow into the payment. Price reduction doesn't do much for you if you saw it. So again, here's the comparisons. And for those listing agents and sellers, think about offering this kind of thing to your buyers because this can really help them buy now versus waiting for rates to come down and get your house off the market. Buyers think about asking for this buy down money, closing cost money, instead of a price reduction. Because again, as you can see, it does a lot more for you. Tim Harrison, Straight Up Mortgage Talk. I hope that helps.